All right, let's get straight into it. And our stock of the day, and one which is a bit of a regular here on the call, TechnologyOne, the big technology group, with profits coming in at the top end of company guidance, up nearly 20% for financial year 21 to the end of September. The company saying the result was underpinned by solid growth in its global software as a service product. Look Ahead Management says it's on track to hit its medium-term goal of $500 million in annual recurring revenues by FY26. Shareholders set to get a healthy 10% or 10 cent per share dividend. Checking in on how the shares are faring during this at this particular session. Basically, line ball at $12.47. But Kevin Robertson, I think TechnologyOne has been a bit of a favourite of Teaminvest over a number of years as well, hasn't it?
It certainly has. We've considered it a wealth winner for quite a while, and they regularly under-promise and over-deliver in terms of results, which is great. And they've got very stable growth, earnings growth. And well, for us at the moment, certainly for me, and I'm a shareholder, for me, the price is a bit too high at the moment. I'm always waiting for something to happen and the price to come down so I can buy some more. I remember an interview with Warren Buffett, and the questioner led with that he has too few Berkshire shares, and that's how I feel about TechnologyOne. I've got too few of them.
Oh, okay. So you're waiting for what level does it need to come down to for you to add?
At this stage, it probably needs to come down to about, I'd say about $9.
Wow, that's down a third.
Yes, I know. That's the problem. I might start looking at it at 10 and maybe start easing into it. But yeah.
Yeah. Okay. Scott, what do you think of TechnologyOne, the result and the stock at the moment? It's Brisbane based, isn't it? It's a great performer, but has tended to go under the radar a little bit of the the sexy tech stocks.
Koshy, that's such a really important point, mate. This is one of the businesses that has just continued to do a wonderful, wonderful job for years, like years and years. And look, it's under the radar from a media coverage perspective, at least not here at ausbiz, but the mainstream media, under the radar a little bit because it's not exciting. It doesn't get the headlines, doesn't get the clicks. It's not particularly super exciting from a business story perspective, but the results have been great. I guess that's the challenge, right? They're providing mostly government services, or software services to government, I should say. And during that space, you're not exactly going to get a whole lot of investor excitement jumping on the hot new thing. It's not going to be a meme stock anytime soon. You're not going to have a lot of consumer engagement like a buy now, pay later player. But the results have been phenomenal. I completely agree with Kevin. Look, tough crowd today. The share's down 3.5% or so on the back of what looks, as you say, top end of guidance for their profit growth. The SaaS revenues are going really, really nicely. The only thing I would say, and I will agree with Kevin entirely, unfortunately, is paying 56 times earnings for this business is asking a great deal. Now, as you say, under the radar at a top level. On the flip side, those who own it are super loyal shareholders. And so this is one that's always had a premium PE. Arguably, for much of its life, it has deserved that PE because it keeps getting it done. But I don't know how you pay 60 times earnings for TechnologyOne, unfortunately. Again, what do you predict? What do you look at? Again, it's not the company's fault, right? When the shares get too high, it's investors getting a little bit carried away, I think. I don't blame them for looking for quality. I don't blame them for looking for reliability, dependability. That's all true for TechOne. You just can't pay 56 times earnings for a business that isn't going to double anytime soon. And again, that's a high bar, but if you're paying 56 times earnings, it's almost what you're expecting. Remembering the market average is probably in the teens, maybe the high teens at the moment. You're paying 3-ish times the average PE. It's not worth that much, unfortunately. So I can't buy it at the current price. Like Kevin, again, you say down a third, we're predicting a fall of that. It's not that at all. But yeah, you'd want a PE 30 something probably in front of it. Probably, I'd love 20 something. Maybe you never get that, but just way too expensive for me.
And even though I criticise Kevin a little bit, going, wait for it to drop a third, it was down at those levels in June. So not so long ago that it was down around that 950 mark.
Look, I mean, the thing is, it's really possible for these things to be volatile. It's also possible that people pay up for a long time. So saying I wouldn't buy it unless it was down there, it may never get back there, and that's okay. It's completely okay to give companies a pass on a whole lot of bases, right? It doesn't mean you're not going to make money. It doesn't mean you can't go up from here. On the balance of probabilities, you look at something like this, to use that legal term, and say, well, am I likely to be a market-beating return from here? You've got to get growth in the profitability. You've got to hope PE stays roughly the same level. If the PE falls by 20%, there's not much 20 points, sorry, there's not much the profit can do to keep up with that. And that's the challenge when you're starting into these sort of high PE headwinds, unfortunately.
All right.